to stick with the Fed's decision here and the economic impact that it could have down the road. And for that, I want to bring in Steven Skancke, he's Keel Point Chief Economic Advisor there. And Steven, just what did, when we take a look at what the Fed announced today, one of the things that we haven't really addressed yet is just the Fed's ballooning balance sheet at $6.6 trillion as of last Wednesday. What do you think that means? What are the broader implications of that for the U.S. economy?
It's hard to know the answer to that, Seana, because it's never been done before. I agree that all the things that they've done are the right things to do. They announced these 11 emergency facilities. They've only started down the path with a few of those. So where it goes ultimately is a little bit hard to know. Clearly, it has an impact on their effectiveness over time. Diminishing return sets in, the more they grow this and the more they venture off into different asset areas with their bond buying program. Ultimately, we know that there will be a price to pay on the inflation side of things, especially when the velocity of money comes back to a more normal time, when consumer confidence returns and folks settle down and stop holding all the cash that has been built up offline.
Hey, Steve, it's Adam Shapiro. Good to see you. I can't believe I'm about to say it, but I would actually welcome some inflation. I think that the things that some of us have covered and that you've made you've done this from the White House and from Capitol Hill for decades. You see the picture much differently than the rest of us. And how do we get inflation back? It seems like the Fed is fighting a disinflation and a fear of something worse than inflation, the opposite.
And that's been a big fear that they've had because, as you know, you can't. Stopping a disinflation is very hard. There's the theoretical monetary economics issues of basically pushing a rope in the so-called liquidity trap. And the Fed is very fearful of that. And so they acted proactively, preemptively to get out in front to let everyone know that binding in credit markets wasn't going to be something that they were going to allow to have happen, and that there would be plenty of liquidity so that the expected economic consequences that have been reported today and right along were not going to be exacerbated by limitations in liquidity and credit. But sure, when consumer confidence comes back and spending does return, and I think, too, when things settle down and we see business investment come back into play, and there's a lot of deferred business investment that needs to be made, that the demand for these goods and services will find some bottlenecks in the economy, and we will see some inflation as a result of those bottlenecks. And we'll also see some inflation, price inflation, as the production supply chain part of the global economy up fully and efficiently with what will be the demand for those in rebuilding companies' capital balance sheet and consumers coming back into the marketplace too.
That on top of the fact that I think we're all counting on Congress and the administration an additional, I'm going to say $1 trillion, maybe even more in fiscal stimulus as we go forward. But then you get statements from Treasury about this issue of not bailing out states, not bailing out municipalities, which might have mismanaged their funds. And you have the Fed, essentially, they haven't done it yet, but prepared to buy up muni bonds to do exactly that. It's kind of like pointing a gun at yourself and saying, I'm going to shoot myself if you don't do what I say.
Well, what's interesting about this, Adam, is that the Fed probably sees this more clearly than anyone, and not that people in the White House and Capitol Hill can't see it clearly, but what they see then gets clouded and colored by the political dimension of it. So all of a sudden, the need to do something for state governments in particular, who actually stand behind county and municipalities, just becomes a political issue. And you've seen that with some of the discussion that's just arisen in the last couple of days. But the Fed doesn't have to look at that. They can see the damage that state financial stress has on just managing the crisis and providing essential services. So they're ready to step into that. The other thing that's really difficult is the lag time that we get on Congress passing the CARES Act and something really happening. We've all seen it in just the delay in checks and the paycheck protection and how that's worked. Even as remarkably quickly as that has been implemented, still more than 50% of the money appropriated in the CARES Act is not in the hands of the intended recipients. So it's a little bit hard to gauge how all that works and where the friction is, especially as it trickles into the credit markets. But the Fed can move on that almost instantaneously with the way it operates through banks or the way it leverages different relationships in these 11 emergency facilities that it's set up, even though not all of them have been implemented yet.
All right, yep, that's something we will, of course, continue to watch here. Steven Skancke, Keel Point Chief Economic Advisor. Thanks so much for taking the time to join the show this afternoon.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.